Good morning, Allegedly Squad. This is your friendly former financial analyst, Tom. And in today's video, I got a lot of bangers for you. We have some bad news for Tesla. Actually, legitimately bad news, not clickbait. Elon's compensation plan is under fire. And we have some news from TSMC, the chip manufacturers from Taiwan, with a surprising announcement about how fast they can actually catch up with the auto industry demand. It is way faster than I initially thought. Again, there's a disclaimer there to be made, but most importantly, Berkshire Hathaway and Warren Buffett actually had their annual meeting yesterday, and they brought a banger of a show, including an actual legitimate bombshell. Again, not clickbait. They actually named a successor, which has been in the works for 15 years. We've been waiting to hear who that's going to be. And actually now we already know. Yesterday they revealed the successor. I'm going to let you know in a second. You know I don't hold you hostage. Before we get started, an important disclaimer. Everything you hear here is my opinion. By the way, you notice the here. It is strictly my opinion. It is not fact. It might be inaccurate. It might be completely wrong. It might be the ramblings of a madman. You got to do your own research. Allegedly, blah, blah, mother effing blah. Before we get started, don't click nothing. Don't smash nothing. Don't sign up or buy nothing. Just listen up and take in the news because we got a lot to talk about. So first of all, let's start with Tesla and Giga Berlin. Now, it seems that the Berlin factory is being held up by 6 months. Now, in any other country, I would say, well, this is bad news. 6 months is a massive delay. However, you got to understand Germany. And if you're from Europe like me, you know that Germany is kind of known for the bureaucracy and the red tape and how hard it is to get shit done over there. In fact, I believe their airport in Berlin was delayed for 9 years. And it seems that instead of June, the actual launch will be in January, which is not a huge deal, especially given how things work in Germany. For Germany, 6 months delay, it's actually pretty normal. You got to understand that with every project, you always have to expect delays, cost overruns. A lot of things don't always work out like you plan, especially with massive infrastructure projects, especially in Germany. So a 6 months delay actually seems reasonable to me. No big deal. However, although I think the Tesla people will be speaking out about how horrible the bureaucracy is, I think they're actually happy that they get to delay this by 6 months, because you have to understand that Germany, according to what Elon hinted on the call a few days ago, will be the test bed for all the new technology. Which means that the new Model Ys with the new battery, the 4680, are supposed to come out of Giga Berlin. Now, that thing ain't ready yet because he himself said in the conversation that he had with shareholders a few days ago that those batteries are at least 12 to 18 months away. If I remember correctly, comment below, let me know if my time frame is off. So in fact, it seems that this delay is actually good for Tesla PR because it's going to be playing into their hands, essentially holding off the production and launching only in January, because I believe they do want to eventually roll out the 4680s from that factory. Now, another Tesla news before we go to Berkshire Hathaway and all that good stuff. So Elon's plan actually is again in the middle of the discussion because everybody's going gaga about Elon's stocks. Now, Elon is probably vested at 32 billion already as far as the stock he can actually purchase through options. And the 32 billion is actually the difference. That's what he actually stands to gain based on his exercise price, which I think on average is like $70. Now, here's the thing. A lot of people have this urge to go out and get their pitchforks and completely go at Elon at this. Well, nobody should make $32 billion. Oh, hold on there, sport. You got to understand that, first of all, Elon is probably one of the most extraordinary CEOs of our generation. So he got a lot of shit done. So he kind of deserves the money. Beyond the fact that I want to explain here that Elon never took a salary from Tesla, ever. No salary for a good 13 years. So not taking salary, going full stock options compensation means that this guy was betting on the company. He took a lot of risk. So those 32 billion that already is vested, by the way, that's not the end of it. He still has a much bigger potential there. Actually reflects the risk he took, not taking any salary. And in fact, I definitely think he outperformed and executed, so he deserves the money. I have no ill will for him taking that cash. However, what I also want you guys to understand is that Elon doesn't really need that money because he was an independent billionaire before he even invested in Tesla. That's right. A lot of people don't remember that, but he didn't found Tesla. He actually invested in it. Then he became the CEO, quite early, by the way. But he was a billionaire because he sold PayPal with Peter Thiel, so he doesn't really need the money. Beyond that, imagine if you had tens of billions, would you want to invest in a rocket company that sends rockets into space, that's a losing project by definition. Would you start an EV company, a boring company, or a boring company as far as, just a not interesting one? You would just buy real estate and just live off the interest. Be independently billionaire for the rest of your life. He didn't need to take these risks whatsoever. He did it because he wanted to get interesting shit done. And I applaud him for that. He could have just sat back on his porch, had a Mai Tai, and enjoy his money by investing in real estate or stuff like that have pretty much no risk or very little risk. Investing in these companies, which take up 150% of his time, including sleeping at the factory for an extended periods of time, and actually going and risking your money, your reputation, and wasting your time, it actually means a lot. So he definitely deserves the money, in my opinion. If you have a different one, comment below. Now, moving on to spicy stuff. TSMC actually just announced that they're about to catch up with the automotive demand for chips by the end of June, which means next month. Does this mean the crisis is over? Not exactly, because you actually have to read the entire interview, not just the Russian accent there, not just the headlines. Let me show you. And I think you absolutely have to read this paragraph to get some context. In this paragraph, they essentially asked them, well, do you think this means that the auto chip shortage will end in 2 months? He said, no. There's a time lag. In car chips particularly, the supply chain is long and complex. The supply takes about 7 to 8 months. So here's the thing. What he was referring to is actually TSMC being able to catch a breath to get to the minimum requirements just to be able to produce. That's definitely not the end of the crisis. He said it, 7 to 8 months, probably looking at Q1, probably Q2 of next year for the chip shortage. So it's really interesting to see that they're putting out these headlines. However, not a lot has changed. We know TSMC are expanding capacity, but we're probably looking at good 7 to 8 months for this chip shortage to continue. And now moving on to the main event, the Berkshire Hathaway annual shareholders meeting. And did we have a banger or what? Now, Charlie Munger and Warren Buffett, you could not mistake them. They're definitely not acting, speaking, or thinking their age. These guys are 97 and 90 years old. They're at their prime. Oh my goodness. You can hate on them. You can say they're dinosaurs, outdated, whatever. I absolutely love this. They were on fire, including announcing finally the successor to Warren Buffett. Charlie Munger and Warren Buffett actually confirmed that the successor to Warren Buffett, once he retires, is going to be Greg Abel, 59 years old, been a long time with the company. He heads the non-insurance business of Berkshire Hathaway, and he's going to be the successor. Big news, because now we actually know who's the guy in line. I think they definitely have a succession plan. I believe that Greg Abel is heavily involved with the management as it is, so it's going to be a smooth transition. However, check this out. This was not even close to being the main event of this thing, because we had a lot of bangers from Warren and Charlie Munger. We absolutely have to talk about the main highlights because there's a lot to talk about. And as you'd expect, Warren Buffett went back to the well, going hard on how ETFs outperform any other investment strategy, especially for retail investors. Now, we all know that people like to call him outdated and he's a dinosaur, but check out what he said. Out of the 30 companies, which was the leading companies in 1990, which companies are still on the list 30 years later? None. That's the crazy part. However, if you just invest in the S&P 500, let's say you just invested in the S&P 500, and by the way, that's my take on this, 2 years ago. If you just invested in the S&P 500 2 years ago, you did 40% on your money with literally very low risk. The S&P 500 is one of the greatest cheat codes in the investment industry, and it's a known secret. And a lot of these financial managers, money managers, professional managers, they want you to think that they can beat the S&P 500 because they have some crazy magic trick up their sleeve or some technique. They can't. Consistently, over the course of 10 years, almost no financial manager can consistently beat the S&P 500 every year because it's literally betting against the economy, which is never a good thing. So I completely agree with Warren Buffett. You can call me a boomer, you can call me a dinosaur, but hey, I'll take my 40% over 2 years over any other company. Of course, it's always nice to scratch lottery tickets, and I'm not saying you should not invest in individual companies, but I have a big chunk of my investment portfolio, which I think you should as well, in the S&P 500, because betting against the economy is never a good idea. If you are patient, if you have a 5-year horizon, that's probably one of the smartest investments you can do because you're not dependent on the performance of any specific company, just on the economy growing, which over the long run, it always does. And next up, we have the odd couple, Apple and Airlines. how does Apple and airlines actually combine? Well, Warren Buffett actually sold airline holdings completely and trimmed Apple position just before the big spike. And the question was from the audience, taking a little bit of a shot at Warren, what does he think about that? He had a different answer for both questions. For Apple, he said that might have been a mistake. As I agree with him, I think Apple are in front of a major boom that people can't see yet. For airlines, he said, I'm doubling down. Don't like airlines. Margins are not great. Industry is problematic. Travel ain't coming back so fast. Not the best investment. I see better opportunities out there, but best of luck to airlines. Apple probably should not have sold. I agree with him. Next up, we had Charlie Munger actually take some shots at the money printer of the US government, basically saying, hey, federal spending is going out of control. We can't keep this up. This has got to stop. Essentially taking some shots at Jerome Powell sitting at the printer, basically saying, hey, somebody has to pay the tab for this thing. We can't keep doing this. We can't just print money like nothing happens. Now, I actually agree with Charlie Munger here, but check out what he said. Now, I do think there's a good chance that this extreme conduct is more feasible than everybody thought, which is actually agreeing a little bit with Powell here. But I do know that if you just keep doing it without any limit, it will end in disaster. Essentially saying, hey, dude, you just dodged the bullet with this crazy printing. It's time we slow down a little bit. No more stimulus, no more infrastructure spending. Let things just mellow down. You dodged one. Good. Let's move on. Essentially, what he's warning from here is inflation. He's warning from stagnation, a lot of issues that can come up with this crazy spending. I think Charlie Munger, again, is on point here, but you didn't really think I would disagree with him, right? And then after things warmed up a little bit, we had Warren Buffett get off his seat and take some massive shots at SPACs, basically saying, hey, SPACs are not here to stay. It's a fad. It will blow over. Essentially, his main issue was with the structural part of SPACs, limiting the timeline for 2 years, putting a lot of pressure on management to actually park the money somewhere, creates inefficiencies. I agree, but I do not think that this is the main problem with SPACs, and I want to complement this point by giving another perspective. I think that the inherent flaw with SPACs is not necessarily the structural problem that he's talking about. It's more the problem of the type of investor you actually attract. Now, here's the thing. When you have people giving money without knowing which company this money will be invested in, you have no relationship. That's incredibly dangerous because unlike an IPO, with this type of investment, the original investor has no idea where the money is going, meaning he's not emotionally invested in a company. He doesn't care. He doesn't necessarily believe in the company. He couldn't care less. Now, when you have this relationship between the original investor and the company, you have a massive selling pressure. That's why in SPACs, you always see this massive spike once it's announced and then a slow decay. Because all of these investors are going through the door, basically saying sayonara, because none of them, or at least for the most part, most of them, they don't necessarily believe in the company because the way SPACs are structured. In an IPO, I gotta love the company to put my money down. In a SPAC, that's not the case. And here's where I see the main issue with SPAC. But in general, I completely agree with the conclusion of Warren here. SPACs are definitely not here to stay. It's extremely inefficient. And I think in the long run, they will fizzle out. And of course, as you would expect, we had a Charlie Munger shot at Bitcoin, calling it disgusting and contrary to the interest of civilization. I lost my breath there for a second. I completely disagree. You know, I like Charlie. I like Warren. I'm a huge fan. I think that they're extremely smart, but I think they lack the ability to completely understand what this thing really is, as evident by the last thing he actually said. What he said here, I don't welcome a currency that is so useful to kidnappers and extortionists. I mean, this is probably Bitcoin's issues about 10 years ago. Bitcoin these days are being adopted by massive institutions, big time companies. You can actually buy a Tesla with Bitcoin. And here's the thing, this criticism was valid 5, 6 years ago, maybe even 7 years ago. Bitcoin has completely changed, but it did it so fast that people like Buffett, like Munger, can't keep up. It's a completely new economy. Blockchain is the future. So I completely disagree here, but I think it's okay because they run a completely different shop where Bitcoin is irrelevant. So let's just leave it at that. It's one man's opinion, which I respect, but I think it's wrong. And you do you, I do me, Charlie does his, it's fine. And then we had Warren Buffett basically issue a warning to Robinhood actually gamifying trading. Here's what he said. It's become a very significant part of the casino group that has joined into the stock market. And you had Charlie and Warren actually agree on this point, basically saying this is a casino now. These guys are playing a game. This is a very dangerous game. Beyond the fact that Charlie Munger basically said, hey, Paying for order flow is a bad idea. It's like waving a red cloth in front of a bull. I think he's right. When you're paying for order flow, essentially you're incentivizing the brokerage to provide more deals to the actual market makers, creating a bigger incentive for higher frequency trading versus long-term investing, which is always the best idea for retail investors. So where do I stand on this? I think that paying for order flow is quite dangerous. I agree with Charlie here. I think that creating this incentive to increase the frequency of trading because this is how you get paid is a very problematic concept. I'd rather pay a fee and just hold my stuff forever. Not forever, but for a very long time. Thank you for watching. We appreciate your time. Thank you for the channel members and the Patreon for making this possible. We'll see you guys tomorrow.